Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about a good question that someone has brought up on Twitter. This is the question that I think should be, everyone should be asking this question. I'll put it that way. And I'll give you, again, my financial opinion on what I think is the answer to the question or the data that we've got to go off of to try to answer the question. I mean, obviously, no one's going to know this with 100% certainty, but there's the evidence that we can look at and that we can compile a case for one direction or the other. So here's the question that I think it's a great question. I like the question a lot. Here's the underlying question. Is inflation indeed structurally driven this time or more of a one-off event due to helicopter fiscal? That is a great question. And that is exactly why I go through all these charts, look at the big picture view. I had Patrick on. We were talking about it. So let's go over the evidence of why this is structural. And let's go over the evidence of why this could be a one-time effect. So when we look at the one-time effect, I pulled up some data here. I went to long-term trends and I looked at the M2 money supply growth versus inflation. The black line here, I'm going to zoom in on it. The black line on top is your M2 money growth. The red line on the bottom is your inflation rate. Now, the M2 money growth that went up to 20-something percent, 27% of M2 money growth was in January 31st, 2021. Now, the lag behind this, the money comes into the system first, and then inflation lags behind it. So if you were to look at this, you could say that this move here, this little hump there, where it started in 2018, coming on up, is actually the bottom here in 2020. So it's about a 1.5 to 2 year lag behind. Inflation's about a 1.5 to 2 year lag behind the M2 money supply. So if you add a 1.5 from the peak of that money supply growth of January of 2021, you add a 1.5 to it, that puts you out at about 2023, mid of 2023. If you add 2 years to it, it puts you into, mid of 2022 to beginning of 2023 as this peak. But we also printed a bunch behind it. So you add 2 years, the end of 2023, we're going to be elevated probably at least to the end of 2023, beginning of 2024. And it highly depends how this money gets spent through the system, what the velocity does, et cetera, et cetera. So this could be evidence of this M2 money supply peaking and coming back down for a one-time hit, a one-off event where money was created, stimulus. And now that stimulus is coming back. You can see the black line going down to 4.11%, which is somewhat more normal over time, which would give us an inflation rate of 2% or something like that. Because last time we had about a 4% money supply, the inflation rate was 2.2%. So somewhere on the lines of that. But that's going to take time to filter through. The CPI numbers are also they're going off of a base effect, which is a year lag. So it's going to probably be till next March or something like that, where the base number comes up high enough and our inflation rate starts to compress off that base. So that could be in the camp of the one-off, one-time event because of all the stimulus that was created during that time frame. Now, the thing that is different is if I were to pull up some charts and we were to look at some of the long-term impacts where it's not going to be a one-off effect. So if we were to look at something like the 10-year yield, we've got this nice long-term base that we've come down all the way for 40 years. And we're breaking that long-term downtrend here recently to the upside. So from a yields perspective, we have a new shift to an increasing interest rate environment. This is signaling that it's structural, not If it was a one-time thing, what we would see is this would come all the way back down, and you'd see it come back below and be in this terminal decline, we'll call it. But if we hold above here and we continue higher, I think it's structural by nature. So what is causing the structural market conditions to move higher here? What is causing all this? And back, we'll call it previously, if we look at previous examples of inflationary times, it was demographic driven. It was growth in the money supply, and then the supply of goods and services would catch up. So what kept this all in balance was the supply of goods and services in ever greater quantities to match the money supply growth. That's really what it breaks down to. Now, if you're saying that you're going to have structural inflation, what that means is that the money supply will grow at a faster rate than your GDP or supply of goods and services when measuring it the way they measure it through the consumer price index. And I think that's a high likelihood. So what we're seeing now is an energy crisis. An energy crisis that hit Europe. You can see their consumer price index goes absolutely ballistic to the upside. The question that you should be answering is, or be asking and answering is, the question is that problem going to get fixed? And I think the answer is no. I don't think it's going to be fixed in the short term. I think it's going to take a long time, and it may not ever really get fixed. So why do I say that? Let's just look at the energy side of things. What happened was the world was coming up. We printed a lot of money. That money comes into the system, puts everything into a shortage. That is thereby inflation. I think Russia and some of these other countries saw it as an opportunity to cut the energy to these countries that are printing a lot of money. That's mainly Europe. So they used it as a weapon, and they basically cut. And in defense of them, the weapon that they had was that they're going to get useless dollars for their commodities. So it wasn't a favorable bet for them, and it wasn't a good thing that Europe and all these other countries did either. So I could understand both sides of the argument. I'm just stating both sides. I'm not on either side. So the energy constraint in the system is limiting that GDP growth. And the debt in the system is increasing and rocketing higher. There's your imbalance. That is what's causing the consumer price index to go ballistic. It's a constraint on the supply side of energy, which then hits other things as well. So when you look at this, the question that you're going to ask yourself, if it's going to be structural by nature, is do we have constraints on the commodity side which will limit GDP growth? And my answer is yes, we have a whole bunch. We've got copper, we've got nickel, cobalt, lithium, graphite, everything. And those constraints are going to limit GDP growth to some extent. I also think that we have an energy problem worldwide where things are going to get tight, and it could last forever. And I say forever. It's not. So we came into an industrialized world way back in the day. We found oil, and then everything accelerated. It massively accelerated population growth, GDP growth, the growth of everything. Humans were living on top of the world because we have all this excess energy. The energy is what supplied the entire world with all of these extra goods and services and wealth. Now, as this goes up, your decline rates of oil, they start attacking it harder and harder. They go down, and they go down. The farther you go up, the more it comes back down. The decline rates. So you have to offset greater and greater declines in your production base as your production base grows higher. And right now, we're at a very high level where we are probably losing something on the lines of 8 to 10 million barrels a year. Just to stay flat, we need to find new production of 8 to 10 million barrels. I don't think from a oil perspective, and I'm not an oil expert, this is just me looking at it and looking at all some of the data, I think that, maybe we've got a decade left of it. I don't even think we've got that. I don't think that we can find a new Saudi Arabia every single year for the next 10 years. So the energy side will be constrained. Hence why I like investments in oil, natural gas. And natural gas will be constrained at some point too, because these shales are short-term little hits. They're not long-term big productive capacity kind of growing the base of it. They kind of just hit and then they decline off, hit, decline off. So the decline rates are getting quite large on a very large base, and it's getting more difficult to offset those declines worldwide. As technology improves, we do see some of the decline rates slow down. We can become more efficient at extracting it, but that only furthers the problem. It doesn't actually help the problem. It slows down the growth rate, and then eventually it'll all fall off a cliff. Because you're becoming more efficient at extracting the oil out of the ground, and that will have short-term benefits. With long-term, I think you'll see the decline rates accelerate towards the back end of some of these, depending on how they're managed or mismanaged, the actual production of oil out of those wells. So I think that it's structural by nature, because what happens is in an energy crisis, and if we hit energy constraints, what we're seeing, and we're also seeing a botched transition, and I don't think this transition can exist into renewables as the way that we see it, renewables in solar and in wind, because the costs of those have come down because energy has gone down and the commodities of the price of those commodities have come down. As these all reverse and the price of the commodities go up and the price of energy goes up, renewables do not become more favorable. They become less favorable because they are highly linked. Their costs are highly linked to the commodity prices themselves. There is no Moore's law. It's all a fallacy, in my opinion. If you were to chart the commodity index and chart the price of these things, they just follow the commodity index down, and they're going to follow the price back up. So I don't think that they are viable alternative solutions on a wide scale to replace fossil fuels. The only game in town, in my opinion, is nuclear, and we're going to have to adopt nuclear in the biggest fashion that we've ever seen. That's my take. That's my opinion there. And from a structural inflation standpoint, I think that the inflation is going to be driven by energy and a shortage of commodities. So GDP will be constrained in the debt-based system. It needs to grow, and there's your problem. The difference between how the system is designed and constraints in commodities and energy. And that's really it. So the structural inflation that we are seeing is going to be driven by commodities and energy. And it's going to put pressure on bond markets because inflation goes up, interest rates go higher, and then there's going to be pressure that builds on the bond market. And usually what they do, the central banks, is they're going to relieve the pressure in the bond market and destroy and transfer that pressure towards their currencies. And then you'll see currencies that get destroyed. They almost always handle this from an inflationary standpoint, not from a deflationary kind of crisis that happens. So that's my take on it. Maybe we've got more commodities out there than I'm aware of, than what I am aware of. I don't think so. You can look at the ore grades. The ore grades coming online for copper are quite low. They're 0.5% or lower in a lot of these new mines, and they're a lot smaller mines. And I mean, we're going to have to bring on a whole bunch. And if you bring on lower ore grades, the impact on your energy consumption ramps up dramatically. So I think that's the right market conditions. Now, if you look at from an investment standpoint, if the pressure is going to kind of transfer from bond markets to currencies in this type of environment, and we look at the history and we look at the 1970s, which was an energy crisis at the beginning, and then we didn't even see too much of a commodity constraint during that time frame. It was mainly an energy crisis, and only an energy crisis that was directed towards the United States of 1970 peak oil. But if you look, there was commodities and energy throughout the world. So that pressure that was built in the 1970s, which was inflationary because we had a demographic, the baby boomers come into home buying years, which had more money into the system, and we had an energy constraint. That was, I think, the underlying market conditions that drove oil, commodities, and precious metals to levels that were much higher than seen before at rates of increases, I should say. The rate of increase was higher than we've ever seen before. I think the same type of market conditions are coming on a worldwide scale now. So if you were to kind of think of this, we have the millennials coming into home buying years. We've had a lot of other countries coming into home buying years, and they did stimulus on top of it, and a whole bunch of money came into the system. It put everything into a shortage. And now we have an energy constrained world. And we haven't been investing in it. And I'll tell you this, I don't know if that's going to help. It may help a little bit, but I don't know if it will cure or fix the problem from a decade-long approach. At some point, we will hit a peak in oil production. And I don't know if we have viable alternatives at this time to offset it. I know a lot of people say, oh, we got electric cars. Yeah, but that doesn't solve the problem. The problem is that we're increasing or ramping up energy use at an exponential clip. And we're consuming all these fossil fuels, but there's nothing there to replace it from a renewable standpoint. You're going to have to go to nuclear or some other higher energy return on energy invested source. So I think that's where the problem lies within. It's our energy. The problem is we don't have a infinite energy source. Energy is what the constraint is in the system, and that's what's going to make it structural. That could last. And I don't know if investment will necessarily fix it. Like completely eliminate it. We're going to have to become a lot more efficient with what we use. We're going to have to become a lot more mindful, I think, around the world. And we're in the middle of the S curves of India and China of energy consumption. So I think it's structural by nature by looking at the bond market prices, by looking at all these different ratios starting to break. I think it's going to last a while. That's what this is signaling, is that the trend line is broken and that we're heading higher, at least on the 10-year yield. The 30-year yields also got it from the longer end of the curve, and it's heading higher. We also can see that commodities have broken out to the upside of its falling wedge into a new era. Now, we're still pulling back. We could still pull back more in the short term. We're getting our first pullback before a nice big move, and I know a lot of people struggle to hold on. But none of the problems have been fixed. We don't have, when you look at the cycle, and just take the real estate cycle, for example. We go into a recession, we come into a recovery phase, we go to an expansion phase, and then we have a hyper supply phase. That cycle can be basically put to anything. You can apply it to anything if you think about it. So we go into this recovery phase, which we've been in, and the recovery phase is kind of like you're finding and drilling for new deposits. Then we go into a hyper supply phase. Hyper supply phase means that you kill the pricing pressures with supply response. And right now, I don't see a supply response from housing. The imbalances are still there. And yes, demand can be held down, contained with higher interest rates, but the supply never came. We never hit a hyper supply phase. We're hitting a phase where demand just gets mutilated, held off. But it doesn't build more homes. It doesn't solve a shortage of homes by not building homes. And we'll see if the homes come online. That's something we'll watch and monitor together on the channel. But right now, and what I look at in all these different charts is it's structural by nature. We've broken all of these big downtrending patterns. We've broken the falling wedges and stuff like that in a lot of the commodities. You can see that the money flows are starting to flow from stocks to everything else. We're seeing the stock market roll over and come back down. And I don't think that the underlying problems have been solved in the system where we've gone from a recovery phase to a hyper supply phase. The expansion phase hasn't happened in commodities yet. That is your structural call. We haven't put the money invested. And even if we do invest, we may not ever go into a hyper supply phase again. We may not produce. I'm in the camp that we are hitting perhaps constraints of what the world can give us and what we can get from the energy. So we're going to have to figure out other energy ways. Maybe it's putting small modular reactors at mine sites, something like that. But most everything ends with some sort of nuclear path, it seems like. So that's what I think. That's what I've got for today. Hopefully you guys enjoyed it. If you guys need help navigating these markets, definitely become a platinum member on the finding-value.com. Again, definitely don't forget to give me a thumbs up, subscribe to the channel, and we'll have a lot of talks about these types of things. But short term, it could be driven by money. That is one thing it could be. That's the short term kind of transitory blip. I showed you what that looks like. The structural, by nature, argument is more commodity driven. And that your inflation will be, and that money flows will move from financial assets and shift towards commodity type stuff to solve those problems. And more of our paychecks and everyone else who works is going to be diverted towards commodities, energy, commodities, food, all those types of things. All right, guys, that's what I've got for today. We'll catch you next time. This is Finding Value.